Welcome to the Wheelbarrow Profits Podcast, where you get multifamily investing made real. Learn from top players in the real estate investment world as they share their secrets with you and discover proven strategies on apartment investing that actually work. To learn more about Wheelbarrow Profits, visit jakeandgino.com, your one-stop shop for everything multifamily. Now to your hosts, Jake and Gino.
Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, I'm doing good this morning. How you doing?
Always making it happen, big man. Today's guest is Tom Wheelwright. Tom is the founder and CEO of Provision CPA firm. He is also a well-known rich dad tax advisor and has been described as the best of the best by President-elect Donald Trump. We're going to take a deep dive into real estate and taxes today. So without further ado, Tom, welcome to the show.
Hey, thanks for having me. It's great to be on your show. Always love talking to real estate investors.
Hey, that's what we're going to be talking about today. So why don't you give us a little bit about your background and how you got started in business?
Yeah, so I've been teaching entrepreneurs and investors for about 35 years how to permanently reduce their taxes, and started after graduating with a master's degree from University of Texas. Started with Ernst & Young back when it was Ernst & Winnie back in the old days, and I actually spent 3 years in the national office. So I've got deja vu all over again because Trump's tax proposals are very similar to Reagan's tax proposals when I was in Washington, D.C. So very, very similar. So interesting history there. And then I started, I worked for a Fortune 500 company, was an in-house tax advisor there, and then started my firm about almost 25 years ago. So we've been, ever since then, we have clients in 50 states, 6 continents, 30 countries. Wow. It's been a fun ride.
Tom, I was just talking to you on the show before we started, and I was so excited to read your book, and I think you're surprised that I read your book, and I think everyone should get a copy of it because it's an awesome book. It'll tell you about taxes and not to be afraid of taxes and to embrace taxes. Can you discuss why tax law is written and who it benefits? I think that's the crux of the book for every entrepreneur.
It is. What most people think about taxes is they think that taxes are primarily to raise revenue. And while that is certainly a use of taxes, let me give you a couple of numbers that might surprise you. Income taxes, the 6,000 pages of income tax code, raise about $2.1 trillion a year for the U.S. government. In that Internal Revenue Code, though, which I describe as a roadmap to reducing taxes, there are $17.1 trillion of tax benefits that are provided to people on an annual basis. So when you compare it, 17.1 trillion of benefits versus $2.1 trillion of revenue raised. So what's the primary purpose? I mean, I always say, I'm an accountant, follow the numbers, right? Mm-hmm. So the primary purpose of the law, and it has been for 50 years, has been to direct the policy of the government, whether it's in the U.S. or any other country. I've been in 20 countries this year, and every country, it's the same. You know, they follow this idea that, look, people hate paying taxes, so if we give them a little tax incentive, they'll do something. And everybody knows that because people buy a house. One of the reasons they buy a house is because they get the home mortgage interest deduction. Why would you ever put money in a 401k or a 529 plan? The only reason you'd ever do it was for the tax benefit, because it's a horrible idea. So everything we do, there's a tax consequence to it, and all I'm saying in tax-free wealth is, embrace it. Just say, look, what are the tax consequences that I can apply to my life that are going to improve my life by reducing my taxes?
Something else really stuck in my book. We're going to get to the 401ks. I know how you love them and the real estate tax benefits. But there's another, I think, strong statement you made in there that it's not how much you own that is important, how much that you can control. Can you tell us how and why? What do you mean by that statement?
Well, so you can own things in your own name, and we're taught to buy things and own them, and ownership is kind of we've heard it's the principle of democracy and all that kind of stuff. But you don't have to own it personally. You can control it through entities. You can use limited liability companies. You can use partnerships. You can use corporations. You can use trusts. All of these different types of entities are set up for specific purposes under the law, and they all have positive opportunities for us, and they all have tax consequences. So, we think about corporations, we go, okay, well, that's to protect myself for legal liability, but it also has tax consequences to have a corporation. And then you really have two primary different types of entities from a tax standpoint. You have those where you pay a tax at that level. So that's a typical corporation. Apple, Google, they pay tax at the corporate level. And then when there's a dividend, actually in the U.S., there's a second tax, which is actually unusual in the world. It's double taxation. Mm-hmm. Then you have the other type of entity, which is we call a flow-through entity, which means that all the entity is, from a tax standpoint, is a reporting mechanism. And what it does is reports the income to the owners, and the owners actually pay the tax on their tax return.
Can you jump into why you favor real estate as an investment vehicle for the before tax returns and the after tax returns, and what shelters does real estate give us?
Well, real estate has some particular advantages under the tax law, but it actually has some advantages outside of the tax law, like you say, before tax. And the big advantage of real estate is leverage. The disadvantage of real estate is liquidity, because there's really no liquidity in real estate, as everybody found out in 2008, right? There's just no liquidity. So that's the downside, and that would be the upside of the stock market. Well, but the upside of real estate compared to really about any other asset is that it's really easy to get financing for it. So debt is, if you think about this, you go, okay, I've got $20,000. I could buy a $20,000 property for cash or a $100,000 property with debt. Which is better? Well, that's not a difficult calculation. I mean, you don't have to be a CPA to make that calculation. If it's throwing off positive income more than your interest expense, you're always better off using debt. So that's really what creates. I think that's the magic of real estate outside of taxes. It's debt. And people that, I know that there are people, very famous people, who promote buying real estate with cash. The challenge with that, one, is you're lowering your returns, but the second challenge with that is you're lowering your tax benefits, because not only do you leverage your returns before tax, but you actually leverage your tax benefits. So, for example, the biggest tax benefit, and I talk about this, I do a whole chapter on this, chapter 7 of tax-free wealth. The whole big tax benefit in real estate is called depreciation. So we don't ever expect, it does happen, as we know, 2008, we don't expect our real estate to go down in value. We expect it to go up in value. Nevertheless, we get a tax benefit equal to the wear and tear, let's say, on the real estate, and on the contents of the real estate, on the land improvements, everything about it. And what happens is that this is something that it's based on what we pay for the property. So go back to my example of $20,000 versus $100,000. So if I buy a $20,000 property, I get depreciation, or a percentage of that $20,000, as a deduction every year. And done right, should be about 10% for the first 5 years. Okay, so I get about a $2,000 deduction. Mm-hmm. All right, well that's great. But if I have a $100,000 property, the bank doesn't get the depreciation deduction. I get the depreciation deduction. But instead of $2,000, now I'm at $10,000. So I've gone from a $2,000 deduction to $10,000 deduction. Well, people who buy real estate for cash typically end up paying tax on the income from the real estate. People who buy real estate using debt never pay tax on their real estate. And we have other tax benefits as well, which, given a president-elect who is a real estate mogul, we would not expect these to change, at least not to the detriment of real estate investors. We have these like-kind exchanges. And like-kind exchange means that I can sell my property, buy another property, upgrade to another property, and not pay any tax. And I can do that forever. And then when I die, actually, my tax, because we have an estate tax, by the way, that would be the downside of getting rid of the estate tax. Because we have an estate tax, my income tax actually goes away when I die. So we have an opportunity in real estate to never pay taxes on the income and to never pay taxes on the gain. It's really the only pure tax-free investment.
Jake, we like that. And one of the things that Rich Dad says, the three tenets of a great investment are leverage, liquidity, and control. And I think real estate gives you the leverage and the control. And Jake and I would like to say, I think it gives you a little liquidity sometimes because you can refi the property. And the downside of having liquidity is you can do something stupid where you can sell something too soon, like hitting a button on a stock and just gone. And so sometimes it's good not to have that liquidity. I push back on that sometimes because maybe it makes you take a long-term horizon, makes you think of the end in mind. So sometimes not having that liquidity actually works to your benefit. So just throwing that in there.
You know what? I think that's fair. I'm very strategic. I mean, the name of my company is Provision Wealth Strategists. Mm-hmm. So, strategy is really part of what we do. And, this strategy, this long-term plan of action is critical when you're investing. It doesn't matter what you're investing in. I think you're right. I think that people who invest in the stock market, particularly if they're in the traditional buy, hold, and pray strategy, just buy it, hold it, pray that it goes up, right? Mm-hmm. Typically, that strategy, people don't think a lot about it. They don't invest the time. They don't take the energy to get the education. It doesn't matter what you're investing in. You've got to get the education. But I think you're right. I think that it's just too easy to get in and out of it. And like this time of year, we're going to see people getting out of the stock market when they maybe shouldn't. We're going to see people staying in the stock market when maybe they shouldn't. And some of that, you're right, I think is because of liquidity. The thing about liquidity is if we focus on cash flow and not appreciation, we don't worry so much about liquidity because if we've got good, solid cash flow in our real estate, then if we have a dip in the market, as long as our rents are enough that we can handle that dip, because in 2008, we didn't see just a dip in value, we saw a dip in rents. And as long as we're not thin, this is just good investing principles, right? Don't be thin in your cash flow. And people got caught up in appreciation. If you're investing for capital gain, you're going to get hammered at some point in your life.
I agree with that. And this is a great segue because you talk a lot about in the book why you don't prefer the traditional vehicles as 401ks, or I know you like Roth IRAs, but the regular IRAs, even self-directed IRAs holding real estate. Can you speak to that a little bit? Why you I wouldn't say hammer them, but you dislike them.
I'm happy to hammer them.
Okay, good. I do too. So
I've been my specialty in tax has been real estate almost since day one. Real estate and oil and gas are my two specialties from an industry standpoint. I started my career in Utah during the oil and gas boom days of the 1980s, and my technical specialty is partnerships, and real estate, of course, is done in partnerships. And so I just gotten really involved in real estate, and real estate just has there's some magic to it. I mean, there's just no other way to put it. I just think there's some magic to real estate in every way, shape, and form. Mm-hmm.
So the traditional 401ks, what do you think what do you dislike about them as far as tax standpoints? Because
So the problem with thank you for bringing me back to that,
because I want you to hammer them. That's why, because Jake and I took a bomb to and we blew our 401ks up. So I have to actually make myself feel good.
All right. Well, let me put it very simply. So when we were in grade school, we all learned that when probably third grade, we were doing our multiplication tables. And that's when we graduated from positive multiplication to negative multiplication. And we said, look, if you take -1 and you multiply it by -1, you have a positive 1. Okay, right? Negative times a negative is a positive. Well, that doesn't always work to our benefit. Let's say you've got real estate, which is a tax shelter, but probably best tax shelter in the world in any country. And you put it into a 401k, which is another tax shelter. What you do is you end up taking a tax shelter, an asset, an investment that should never be taxable, should never, ever pay tax on real estate. By putting it into a 401k, you've converted it to a taxable transaction because when it's in that 401k, when it comes out, it's going to be taxed at ordinary income rates. Mm-hmm. Second of all, you lose your leverage because everybody knows that banks do not like lending to 401ks. They don't like lending to IRAs because you cannot personally guarantee that loan. And if you're doing a small loan, like a single family home or a fourplex or something like that, or you're just starting out, the bank's going to require you to personally guarantee that loan. You cannot do that. It is illegal for you to do that in a 401k or an IRA. Mm-hmm. So you can't get the leverage. So you've lost the debt, plus think about this. If you're leveraging properly your real estate, you're not just getting a tax benefit by not paying tax on the income from the real estate. You're actually probably generating losses from the real estate, just paper losses, that can offset income from other businesses and other investments. Okay, so that's actually a positive tax benefit. That actually increases your rate of return on your real estate. You lose all that. Even in a Roth 401k, you lose all that. Plus, I think they're very dangerous. I know you've had Garrett Sutton on the show, right?
Yep.
So Garrett and I teach this on a regular basis, and what Garrett hates is he doesn't like self-directed IRAs in the first place because people tend to make mistakes with them. Okay, especially these so-called checkbook IRAs where they actually allow you to write a check on them. The challenge is the IRS prohibits any services rendered by you to your IRA. Okay, well, think about it. Okay, so you've got investment real estate. So you're not going to render any services. You're not going to manage that investment. You're not going to, call a property manager. You're going to seriously let some IRA administrator handle your property for you? I mean, to me, that's just a recipe for disaster.
That's the number one reason I liquidated all my funds that I had out there in the Roth and the 401k because I'm too active. I'm too active in it, and I couldn't have done it self-directed. That's the number one reason that I just said I'm not going to do it. Yeah.
And here's another thought for you. Okay, so let's think about a 401k for a minute. Okay, who determines how much you can put into a 401k and when you can put it in?
I was just about to say that the government.
Okay.
Yeah.
Who determines how much you can put in?
Government.
Who determines what you can invest in?
Oh, I guess that's going to be you at some point, no? Because
that would be the government, isn't it? The government.
Well, you're
determines what
you can pick
invest
the funds,
in.
though. I guess what I was saying.
But the government determines what you can invest in.
Fair
okay,
enough.
you can't invest in certain things. Some things you can.
I got you. I was thinking of mutual fund, but I got you.
So,
fair enough.
Yeah, but the government says, okay, put it in the stock market, right? That's what the government says.
Yes.
Right.
Mm-hmm.
So the government's determining when you put it in. Who determines when you can take it out?
Government.
The government.
The government. Okay.
Right.
And if you don't take it out at the right time, who determines if? So and not only that, do they determine you can only take it out once you turn 50 and a half? You take it out before you pay a penalty. Plus, if you don't take it out, if you leave it in too long, you also have a penalty.
That's right. That's 70 and a half. You're right.
So here's my point. If you're not going to get any financial education, do a 401k, invest in mutual funds. I mean, that would be my recommendation. If you're getting no education, if you're not listening, of course, that's not your listeners because listeners here, they're getting education right now. If you're not going to do that, that's fine. But if you're interested in actually getting education and you're willing to take steps to increase your rates of return on investment, to reduce your risk, to have more control, why would you ever put your money in a 401k?
Plus, with debt increasing, national debt increasing, and the likelihood of taxes going up in the future, right? Who's to say what the tax rate's going to be when you're pulling that out, right?
Well, so you make a good point. So the argument of the financial planning community for the 401k, of course, they're arguing it so that you can invest in mutual funds that they sell you, right? But the argument for that is that you're going to be in a lower tax bracket when you retire.
Yes.
Well, that argument only flies if your goal of retirement is to retire poor.
Mm-hmm.
Because if your goal of retirement is to have as much money when you retire as when you were working, you're going to be in a higher tax bracket, not a lower tax bracket. You will never be in a lower tax bracket because A, it's ordinary income. Okay, so you can't manage the type of the tax on the income. Okay, and B, you don't have all the deductions you used to have. I mean, think about it. You don't have your business deductions. You don't have. You probably paid off your house. Right. You don't have that deduction. If you're super lucky, your kids have gone. Okay, so you don't have that. If you don't have that deduction, hey, Gino, do you have any boys?
I have one boy.
Yeah. 1 out of 6.
Okay, so just so you know, the girls leave, the boys always come back.
That's good. I got one, thank God.
You'll get the one. He'll come back. You'll be supporting him for the rest of his life, the rest of your life. Just so you know, I have 2 of them, and they're like a bad penny. They just keep coming back. But
sounds like he's got some millennial basement dwellers there.
Seriously, totally. 2 of them. So no, they're awesome. But you think about that and you go, and people go, yeah, well, I won't have a mortgage payment, so I won't need as much money. I'm going, what, you're going to golf at the municipal golf course Okay, you're going to go to the discount theater. I mean, what do you want to do in your retirement, right? I mean, don't you want to go to first-run movies? Don't you want to, travel first class? Don't you want to play PGA quality golf courses? I mean, I just don't understand this idea that my goal in life is to not live on a park bench.
Yeah.
I mean, for me, I think for anybody listening to this podcast, I would think everybody here wants to retire rich. And I've never met anybody in the world that didn't want to retire rich. And if you're going to retire rich, why would you ever be reliant on a 401k or a stock market over which you have no control?
But it's beaten into our head, so I got out of college, I got into pharmaceutical sales, and everyone was, well, you got to put your money somewhere, right? So I started at the time, okay, I'm going to get a 401k, I'm going to get a Roth, I'm going to get rich.
We all do that.
But it's just beaten to your head. So until you start to educate yourself, you have no idea what else is out there. And that's why, I got trapped into it for a few years, and I said, all right, liquidating, pulling out, and now I'm here. So.
And I'm excited to have you on, Tom, because everyone comes to the realization that they're doing something stupid like Jake when they read Rich Dad, Poor Dad. Everyone has that shift, and it's like, I read Rich Dad, Poor Dad. Everybody on this podcast will always say, out of 10 people, my house is not an asset? 401k, and it's just like, wow, exactly. That is like the shining moment. And hopefully you can get that book before you're 30, before you start making these mistakes. And if you do anytime, it's never the wrong time to start. That's my point. So it's exciting to have you on because you're part of that whole, movement. And I think it's exciting to talk about this stuff, No,
it's a lot of fun, and it's worldwide. It was interesting. Yep. We were actually in Bishkek, Kyrgyzstan this year, Robert and I. We're flying home. We go through security, and everybody in security, I'm not talking about the people flying. I'm talking about the security agents. They want selfies with Robert.
I bet.
They all know him. It is amazing. It is amazing how well known this guy is around the world. And it doesn't matter. We were in Kyrgyzstan, Kazakhstan, Russia, Ukraine. I mean, it's the reason I think that people love it is because it resonates with their soul. Okay? Because Rich Dad Poor Dad is not, there's no content there, right? I mean, everybody who thinks about it goes, well, wait a minute, it doesn't tell me how to do this. Not relevant. What it is, it's an inspiration to our soul to change our lives, to change the way we think about things. Yep. And the best thing you said to me all day so far is that tax-free wealth will change your thought process, change how you think about taxes, that you can embrace the tax law. I mean, think about this. If literally, I was doing my own webinar last night to my people, and we were talking about how the tax law we were actually talking about debt, as it turns out. We were talking about debt. And, Rich Dad Poor Dad talks about good debt and bad debt, right? So good debt is debt where you buy assets, and bad debt is debt where you buy liabilities, right? So you buy a house, that's bad debt. You buy a car, that's bad debt. You buy an investment property, that's good debt. You buy a business, that's good debt because it's putting money in your pocket, right? Well, think about this. The tax law actually promotes that. If you have good debt, you get to deduct the interest. If you have bad debt, you don't. Home mortgage interest is the only exception to that. So the tax law, actually, if you follow the tax law, it won't just reduce your taxes. It'll actually help you build wealth because it's a very good guideline for building wealth. The tax law because remember, what does the government want? The government wants to create jobs, they want to create housing, they want to improve the economy. And that's what they use the tax law for primarily. Okay, so if you're following the tax law the way it's meant to be followed, you're actually going to make more money.
That's great. I'm trying to teach my son that between personal and business debt. Personal debt is something we don't want, and business debt is something that we want to embrace. And he said something to me the other day, Jake. I think you'd be proud of it. He owes me $40, right? So it's eating at him. I'm like, what's the matter? He goes, I don't want to owe anybody any money. I'm like, hallelujah. It's working, right? Because that's the personal side. And he's giving me money to invest in our next property. So all you parents out there, start training your children. It's up to you to teach them the difference between personal debt and business debt. You lever your personal life through your business. And I think Tom illustrated that beautifully, what he just said. So that's the power of taxes. I want to ask you about cost segregation. Could you give us maybe a minute overview of how it works, what it looks like, because it's really important part of our strategy.
Yeah, no, it's very, very important, and people, Here's what happens with cost segregation. I was actually watching a community. This was kind of a blog back and forth where people, this was CPAs actually, my profession, and they were talking about cost segregations. And the question was, is it legal? Is an audit risk, et cetera? And I'm just watching this and I'm going, really? And you people are licensed? I mean, so let me explain first of all what cost segregation is, and let me explain what it isn't.
Great.
Okay. So cost segregation, when you buy a property, you're really buying fundamentally four things. You're buying the land, you're buying the building, you're buying everything that's inside the building, and you're buying everything that's on the land, okay, all the land improvements, okay? Now, the tax law actually treats all four of those things differently, okay? Land, even the IRS knows, and even they're smart enough to know that land does not wear out. So there's no deduction ever for land. There's no depreciation deduction for land. Buildings wear out over a very long period of time. The IRS has decided that period is somewhere between 27 and a half years for residential property, and it's 39 years for commercial property. That's just an arbitrary number that they came up with years ago. Now, that's building, but we also have the contents of the building. Well, okay, so let's say you've got multifamily housing, okay, and you've got a bunch of cabinets, and you've got window coverings, you've got floor coverings, and you've got, now anybody who's ever owned residential property knows that these things do not last very long, all right? I mean, they get hammered by the tenants, right? And they're not going to last probably more than 5 years. And so there's a 5-year depreciation rate on these things, okay? And then on the land improvements, they also don't last that long. You're talking about fencing and landscaping and covered parking, stuff like that. So that under the IRS guidelines is 15 years. What that means is the shorter the year, the faster the depreciation, the higher the depreciation rate. Well, so how do you break out the difference in what you paid for that property between the land, the building, the contents, and the land improvements? That's called a cost segregation. You're just segregating the cost between those four things. Now, here's what you have to do. You must hire a professional to do this. IRS audit guidelines require a CPA and or an engineer. We actually, when we refer out, we refer to people who do both. Okay, they do both. They have both CPAs and engineers on staff. Okay, that's very important because the engineers, go in and look at the drawings, all that kind of stuff, and CPAs have to categorize the stuff. Okay, so that's basically what you're doing. You're just hiring them. Now, a good cost segregation expert, by the way, will tell you how much the tax savings will be before they ever charge you a dime or enroll you in a contract. So it's a no-brainer. I mean, it's a little bit of time to get them the information, but why wouldn't you do that? Now, here's what it isn't. It isn't a red flag on your tax return. In fact, a cost segregation under the law technically is required. Okay, now the IRS doesn't require it. The law does. The IRS has just said we won't require it, but the law technically requires a cost segregation. So it's not an audit risk, okay? And in fact, it's an audit risk if you don't do it right. Don't get me wrong. I mean, if you just arbitrarily say, well, I'm going to take 20% allocate it to contents and 15% allocate to leasehold improvements and 30% allocate to land, you do arbitrary numbers there. All right, now you've got an audit risk. But if you use a professional, you actually have less of an audit risk than you. And not only that, think about this. So you can do a cost segregation at any time during the period you own the property. This is something very few people understand. You do not have to do it the year you buy it. So let's say you bought a property 5 years ago, and what most CPAs do is, without a cost segregation, what are you going to do? You're going to allocate it between land and building. That's it. So typically what I see all the time, I'll see 20% to land, 80% to the building. Okay, 5 years down the road, you get some good advice. You go, I need to do a cost segregation. So you hire somebody to do this cost segregation. Well, now they actually go back in time and said, what would have been the depreciation had I been depreciating it properly over the last 5 years? That adjustment, that difference between what you should have done cumulatively and what you did do is actually a deduction in the year you do the cost segregation. So that means that you actually get to write off all that 5-year property in the year you do the cost segregation, because it should have been fully depreciated by then, and you were depreciating like 2.5% a year. So you get this huge tax benefit, and you can determine when you want to do it. So you go, okay, I don't need the tax benefit now. I'll do it next year, or I'll do it 2 years from now. This is something where you can do. You talk about strategy, Gino.
Yep.
You can strategically. As I was talking to a client just last night. I'm talking to a client. He's got 2 properties, and he's going, do I use the cost segregation in 2016 or 2017? I said, let's wait until you do your tax return, and then we'll know. We'll know exactly, how much do we need to get to where we want to go. We've got this time frame available to us. The IRS gives us 10 months to file our tax return, 9 months in a partnership, right? But they give us 10 months to file a tax return. That's plenty of time to figure out, okay, what's my taxable income? Do I want to do a cost segregation or not this year? And when you do it, it's actually a change from an incorrect method of accounting to a correct method of accounting. So I want to get this through, is that people, CPAs all the time are telling, and other tax advisors are telling their clients, this is risky to do a cost segregation. If somebody tells you that, you just need to run. Okay, just run away.
Why are they doing that?
Well, I have a theory. My theory is that anything that we don't know is risky to us.
Scares us.
Right.
So
we're afraid.
We're afraid of it because it is risky, okay? Because we don't know about it, right? I mean, if I were driving in the Indianapolis 500, that would be risky, because I like to drive, but I've never done that before. Right. So that would be risky because I don't know that, okay? But Danica Patrick does it, no big deal, right? I mean, so it's just a matter of what's risky and what's not. It's a matter of your education and your experience. So people ask me all the time. So Tom, you talk about your firm. How aggressive is your firm? I'm going, we are the most conservative CPA firm in the world. We just understand more of the law.
I like that.
So for us, none of what we do is risky, because we're not going to do anything. I have to sign that tax return. You go to prison, I go with you. I don't want to be any. One of my goals in life is never be anybody's girlfriend. So
that's a good goal, actually. I'm going to put that on my list.
So I'm not going to sign that tax return either. Okay. So we're going to. But the more you understand, the less risk there is. I mean, it's like real estate. Is it risky? How many people tell you it's risky to invest in real estate? Well, yeah, if you're an idiot, it is risky to invest in real estate. If you don't understand what you're doing, it is risky. Debt's risky. Yes, if you don't understand what you're doing, it's very risky. Don't do it if you don't understand what you're doing. But once you understand what you're doing, now all of a sudden that risk goes down, and actually there's risk not to do it.
Mm-hmm. I see Jake drooling over there because of cost seg. That's great advice, and I see the wheels turning over there.
I love how he explained it. It was fantastic, and basically get the right team members on board, and you can be fine, right?
Mm-hmm.
It is.
I see him strategizing because we have a couple cost segs coming up. It's like, okay, when am I waiting? I can see the wheels turning. I'm his half brother now, so I know what he's thinking.
That's awesome.
So, you're talking about all the qualities of a good tax preparer. You laid them out in the book so well. I was wondering if you could share some of those qualities, because a lot of our students go, well, all right, I want a good tax preparer, but what should I look for? What are the qualities that make a good one up?
Well, thanks for asking that. That's actually the first thing when Robert Kiyosaki asked me to write the book. He wanted me to focus on that, because that's a question that both of us get all the time. Okay, when we're on stage, we're always, the first question I'm always going to get is, how do I find a good tax preparer? How do I find a good tax advisor? And that's why chapter 23, that's all it is. It's just, how do you find a good tax advisor? Well, Robert, when he asked me, he said, why don't you give us the top 10 questions that you should ask when interviewing a tax advisor? And I'm going, well, I can do that. And I did that at the end of chapter 23. He said, but there's something more important, and that is the top 10 questions that they should be asking you.
Yep.
Because here's what I think we miss, and actually most tax advisors miss. I can't do anything about your tax situation. You're the only one who can do something about your tax situation. And your tax situation, the tax law is ultimately fair, because anybody if you take a particular fact pattern, if you and Jake are in the exact same situation, you will pay the exact same tax. Okay, so it's fair based on your facts and circumstances. Well, so what does an advisor need to know? An advisor needs to know your facts and circumstances. So the more digging, it's like you go to a doctor. What's the first thing the doctor does? He diagnoses the problem, right? That's the first thing a tax advisor should be doing, is diagnosing the problem. Okay, where's the pain? All right, where does it hurt? Right? I mean, how do you feel here? Do you have a tickle in your throat? Let me look at this, right? That's what a good advisor does. Doesn't matter if you're a legal advisor, a tax advisor, financial advisor, or a health advisor. It doesn't matter. It's all the same. You got to ask the good questions. So the job of the advisor is to ask questions, not to give answers, because you got all the answers. I don't have any of the answers. You have them. So I have to ask you the right questions. And let me give you an example of the right question and the wrong question. So the question I get all the time is, let's see, if I go on a trip, is that deductible? I'm going, it's the wrong question. I can't even possibly begin to answer that question. But here's the right question. If I go on a trip, how do I make it deductible? That's the right question. Okay? Because everything's deductible in every country. Everything's deductible in every country under the right facts and circumstances. Okay? You just have to do it the right way. We actually had a guy, so we're in Chile in May this year, and Robert gets me on stage and he says, so teach him how to deduct a Bentley. And I'm laughing because there's a Bentley on to the side of the stage is a Bentley, because the Bentley and Lamborghini dealer was the primary sponsor of this event. And so we have a Bentley and Lamborghini right there next to us on stage. Of course, Robert owns both a Bentley and a Lamborghini, right? So he loves this. And I go through and I explain how you can deduct a Bentley. So then I get this attorney, this attorney comes up to me at lunch and he says, you can't do that here. And we get that everywhere. I could be in Phoenix, Arizona, and I'd get, you can't do that here. And, my response, of course, is, I'm the youngest of 6 children, so you'll understand this, Gino. My response is, no, you can't do this here. Right? I can do this here. You can't do this here, because you understand how to do this here. But what was interesting is, so the next day, I'm telling Robert about this, and he goes, okay, so the law actually in Chile is you can't deduct automobile expense in a business. So that's, he was coming from a reasonable place, right? So Robert the next day says, all right, so given that, tell him how to deduct a Bentley. And we got up and we actually figured out on stage how to deduct a Bentley in a country where it's illegal to deduct automobile expense. And it's just a different way of thinking. When you say rich dad, poor dad, it's just changing the thought process. That's what we have to do. And that's why I love traveling with Robert, because, I'm always learning new things about, how to think about this. But that's when it comes down to an advisor. And again, it doesn't matter if it's a tax advisor, legal advisor, real estate advisor, it doesn't matter. Okay. The issue, what you really are looking for in my mind is asking the right questions. When I go to a doctor, I want a doctor who asks me the right questions, because then I can get somebody who could, if they're asking me the right questions, first of all, it's pretty easy to tell if somebody's asking you good questions. It's pretty hard to tell if they're giving you good answers, because if you knew if they were giving you good answers, you wouldn't need to ask the question in the first place, because you already knew the answer. But we're pretty well, I think we're pretty well trained to know what a good question is. And if you just start with this idea that, is this deductible? Wrong question. How do I make it deductible? Better question. So it's always how do I get to a better question? And to me, that's what a tax advisor is about. And also make sure, one other thing, people have this idea that a tax preparer and tax advisor, same thing. They should be the same thing. But most tax preparers are not tax advisors. All tax advisors, for the most part, are tax preparers. So do I want a tax preparer who may or may not be a tax advisor, or a tax advisor that I know is a tax preparer? I want somebody who does both things, because what people don't recognize is that there's literally hundreds of things we can do on your tax return to reduce your taxes. So if you don't have a tax advisor mentality that I'm trying to reduce your taxes and I'm just putting numbers on a form, I mean, seriously, I can train a monkey to put numbers on a form, right? And they can do a better job, right, than a lot of tax preparers. But I can't train a monkey how to think about reducing your taxes. That's what a professional tax advisor is for, and that's why your tax advisor, tax preparer should always be the same person.
And I'm going to keep going back to your book again, because something that resonated in the book, you said every expense that you generate in a business deduction has to go towards creating revenue. So simple things like that will make your mind shift into saying, listen, think of an expense as, try to, like you said, going on vacation. Well, if you're going on vacation to Florida, make sure you have some investment property. Or maybe you like to invest there. So it just makes you shift your mind, and maybe you don't know how to do the investment, but at least start thinking down that path and start planning your life that way. That's what I loved about the book.
Well, let me give you an example. I give you a real life example. I had a client, his name's John, and he wanted to learn how to deduct his travel to New Mexico. And because he and his wife go there, New Mexico. I don't know if you've been there before. It's absolutely beautiful.
Beautiful, yeah.
Beautiful place, beautiful mountains. So they'd been going for years, and I gave him just what you said. All right, you need to spend time, doing business in New Mexico. You have to spend more than half your time, half your day doing business. And his business was real estate, as it turns out. He was a developer. So he goes, okay, I can do that. So a month later, he calls me up, and he's all excited. He says, Tom, we got to talk about this. I can't wait to share this with you. And I'm going, really? I mean, you do this all the time. So he comes in, and so we went through, and I said, did you do everything I told you to do? He said, absolutely. I spent 4.5, 5 hours a day, every day, looking at real estate. And so, I documented it, and he asked me, he says, the deductible? I said, yeah. And so we figured out saving about $4,000 a year based on his trips to New Mexico. And I'm going, yeah, $4,000. I know you don't like paying taxes, but that's not going to get you this excited. I said, tell me the rest of the story. And because I just knew there was something else going on. He goes, well, turns out because I was doing what the government told me to do, basically. He says, I found a deal. He's all excited about the deal. I said, tell me about the deal. He says, a development project. He said, I think this is going to net me $1 million by the time I'm done. It'll be a net of $1 million. So I'm going, so John, how long's that deal been there? Is this a brand new deal? And he said, it's been there for years. I said, why didn't you find it until now? He said, I wasn't looking for it.
Yep.
So
see?
by doing what the tax law told him to do, he was looking for it. Okay, So that's why I say the tax law, best way to make money is to understand and follow the tax law. That is absolutely the quickest way, easiest way to make money. You do what the tax law tells you to do, you will make money. And think about it from the government side. The government's given up $4,000. Let's say it doesn't find it the first year. Let's say it takes them 5 years. All right, so the government's given up $20,000. But they're getting taxed on $1 million deal. $1 million deal, I mean, even with good tax advice, he's going to pay $300,000 on that. $20,000 in exchange for $300,000. That's a good deal.
Yep.
Plus, everybody else is going to be involved in all the subcontractors.
Exactly, and you got the
Tom
multiplier
Wheelwright
effect.
as the CPA is getting more money. Everybody's eating, right?
Everybody, that's right, and everybody's spending that money, right? Yep. So there's a multiplier effect. So when our president-elect, talks about, reducing taxes can actually increase the economy, he's not wrong. I mean, how much it can increase, we don't know, but it absolutely, I mean, the tax law has been doing that for years and years. So why would we think it would be any different now?
Yeah,
I agree with that. Jake, any other questions you want to start in the second segment right now?
Yeah, no, I think that you've been a very successful guy. So we like to talk about some personal things like habits. So what is a daily habit that has really made you who you are? A personal habit that's sets you apart from other folks.
That's an interesting question. I don't think I've been asked that one before. I like that. What? I like to take time in the morning. I actually think getting your day started right is important. So one of the things I do is I'm an early riser because morning is it's just better time. You've got a good night's rest. You're ready to go. You're not tired from the day. I don't work in the evening. I never work in the evening. Evening is for reading and socializing, spending time with my lovely wife, and that's relaxing time. I'm not a night person. So first thing in the morning, I want to get my day started right. So I'm always going to read. Okay, I'm always going to caught up on my news. I'm going to read. I'm always going to have something good to eat in the morning because I want that energy that's going to get me started during the day. So I really think it's my mornings that make the difference for me. Is And if I don't get that, I mean, like when I'm traveling, it's really hard, and I traveled actually 3 months this year. 3
Wow.
months. I was actually around the globe 3 times this year with Robert. And, that's hard because, you don't have your routine. And so you kind of get out of it. And so you really have to work hard. My friend Blair Singer, who is a Rich Dad advisor, one of Robert's close friends, Blair travels 10 months of the year.
That would kill me.
And that guy is in such good shape. I mean, he's doing mountain climbers every morning, right? He does burpees. I mean, he's got this whole physical routine, and he never varies, on what he eats. So, I'm not that good, right? If I were traveling that much, I would hope I would be that good, but I actually love being at home.
Me too.
I'm a kind of a homebody, and my wife loves being at home, and we love being at home together. And we had some great traveling. We were in Africa this year, and we were in New Zealand this year, and we were in Paris this year. I mean, so it's hard to it's not like I'm complaining about the travel, but I am saying that on a daily basis, those routines that you establish, I just think routine is very important. Routine makes us comfortable. If we have a positive routine, it can be really good for us. If we have a negative routine, it can be really bad for us. So, if your routine is, the minute you get off work, you sit in front of on a couch, watching TV, and you're eating chips and drinking beer, for 4 hours a night. I mean, that would be a negative routine, right? But, you're preparing a good meal, and you're socializing, and, you're doing some really positive relaxation. You're reading, stuff like that. I'll tell you something that Robert does. So now I've shared what I do. I'm going to tell you something. I'm going to tell you a secret about Robert. I don't think there's anybody who studies as much as Robert Kiyosaki does. Robert is always reading. And when he reads, he does not read a book. He studies a book. I mean, he has tabs on it. He's highlighted. He's discussing it. I mean, this guy is the best student I've ever met. Okay, and I think that's what makes Robert great, is that he's such a great student.
And it's funny, he hates school. Or he hates school, but it's not.
Traditional education is more appropriate.
That's what it is. I mean, you think about it. I mean, what does he do for a living? I mean, he's an educator.
Yep.
It's pure and simple. He's an educator. He's just not a boring educator, and he's educating on things that matter, right? I mean, I'm sorry, but taking a biology class is never going to help me in my life, right? Now, I actually think some of the math classes do. Algebra, basics. Learning to read. They've actually established that people who don't learn to read by 3rd grade have like a 70% chance of failure in life. I mean, it's really, so there are certain fundamental things that we need in school, but, I'm not sure that biology and calculus are 2 of them.
And I actually discovered this whole, early riser thing this year. I started getting up at 6, where before it might have been, 7:30 or whatever. But I have a home office and I work out of the home. So at 6, I literally come down, grab the espresso, and I'm working right away. And I get a 3-hour jump on almost everybody else. So I'm 3 hours into it when everyone else is just getting started. So I think that's huge, and I don't stop at 3. I keep going until whenever the work's done that day. So I think that's huge, and I really discovered that this year. So that, to me, that's the benefit, one of the big benefits of that.
So let me tell you a tax benefit of doing that.
Yeah.
So if you start in your home office, and you end in your home office, all your travel during the day is deductible.
Yep.
Because remember that the first commute you have a day is commuting. It's not deductible. So if you go off to see a real estate property and you don't have an home office, that drive to the real estate property is not deductible. But if you started at your home office, your commute's 30 feet.
Yep.
Okay, so there's a tax benefit to this too. So congrats on the home office.
Ezekiel Elliott, just keep feeding the beast, baby. Right? So this next one I might already know the answer to, but maybe you're going to surprise us. So why don't you share with us your best business book and why? Your most favorite, most beneficial to you.
All right, so this one will absolutely surprise you.
Okay.
My best business book is called Untethered Soul.
Gino, you know that one?
No, I'm writing it down, so I'm going to pick it up and read it.
It is a personal development book. It has nothing to do with business on the surface, but Blair Blair's always telling me, he says, the higher your emotions, the lower your intelligence. And Blair wrote a book called Little Voice Mastery. And we have Michael Singer, who's the author of Untethered Soul. There you go, Little Voice Mastery. There you go.
I got both of his books. So.
Great book. Little Voice Mastery is kind of a subset of Untethered Soul. So Untethered Soul, Michael Singer, and he just put it beautifully. He said, look, we have a roommate living inside our heads, right? And our roommate's always talking to us, and it's always giving us advice, and we're always listening to it. And if we actually thought and followed every single bit of advice, and if we had somebody else telling us that, we'd think they were absolutely nuts. And we'd be furious with them, and yet we listen to it all the time. And I'll tell you a funny story. So we did a whole book study, the Rich Dad Advisors did, on Untethered Soul a couple of months ago, and I'm in Dubai, and this Robert invites all those who play the cash flow game up on stage, and this young woman comes up, and she's dressed in her traditional garb, right? And very small. She's maybe 5'1" and very shy. And she didn't join in with the group. And I said, look, go join in. Be part of the group. Be part of the picture. Be part of it. And she actually came up to me later afterwards, and she said, thank you for pushing me into that. She goes, I tend not to do that. I said, well, that's we call that your roommate. Your roommate's just in there telling you to do that. I said, I actually think I have multiple roommates. She looks at me, she goes, I've got a whole tribe. And I'm laughing so hard. I'm going, oh man, I'm never going to forget that one. I got a whole tribe of people telling me, what to do and talking to me. And what Untethered Soul does is what it's helped me with is it's actually helped me detach myself from that. And so if you observe it, you're always going to have the little voice in there. You can't get rid of those little voices. That's part of who we are. But if we instead of being enthralled by it and following its direction, if we just observe it, then it makes all the difference in the world. So Untethered Soul is really about taking a step back and really becoming who you really are. And what I found in business is that now it's easier to make better decisions because, again, higher emotion, lower intelligence. That means lower emotion, higher intelligence. Well, if you're observing, if you're not invested in it, okay, from an emotional standpoint, you're going to make better decisions. And that's why I think the key to good business is good personal development. I think that's the key to good business. If you want to be a better business person, develop your soul.
There's no coincidence of that in people getting having all their, I guess, good fortune, all their luck happening in their late 30s, early 40s, because that's when you begin personal development. That's what happened to me. I went to life coaching school because I said to myself, am I doing what I want to do? And you start realizing it's not about everything else. It's about what's inside of you. You have all those external blocks. It's the internal blocks, 95% of them inside of you that are holding you back. The external is the government, the economy, or I like to say Obama. I can blame them all I want, but it's not them. It's really me. And that totally resonates with me, what you said. So I have to pick up this book. This is my next selection. Thank you.
Yeah.
How can listeners get a hold of you and partner with your company if that's something that, based on listening to this, that they're looking to do?
Well, thank you for asking that question. That's actually that's probably my favorite question. really want to know. Actually, if you go to taxfreewealthadvisor.com, taxfreewealthadvisor.com, then you can actually get a free copy of Chapter 23, How to Find a Good Tax Advisor. Okay, so we'll give you a free copy of that chapter of the book, which I do think is the most important chapter of the book. And and then you can contact us through there, or you can always call us. Our number is 866-467-5809. 866-467-5809. So you're welcome to call us. We have a ton of information that's free. When I wrote the book, you probably paid $9.99 on Amazon, right? And when I wrote the book, I actually asked my business partner, who was our managing partner at the time, and I said, how much should we give away in this book? Because this is intellectual property. This is stuff that I've spent, at the time I'd spent 30 years developing. He said, give it all. He said, don't hold back. And so pretty much everything I know is in that book. Mm-hmm. And And I love it when people, Gino, thank you for that great, I find that very high praise, say it's easy to read. I had a young woman who told me that it was a good beach read, which I thought was hilarious. Seriously, a book with tax
That's
in
what I
the
was just
title
going to say, yeah.
is not typically what I think of as a beach read, but I actually wrote it's actually my personal history. I mean, if you look at all the stories, I just put my personal stories in there because I feel like, we ought to, I think taxes are fun. Now, I'm a geek, right? So I'm a total tax nerd, and I love reading the tax law. I love learning about it. I love new challenges like that. It's the most complex thing on earth. Einstein actually said that that the most difficult thing in the world to understand is the income tax, and I love that challenge. Okay, but it doesn't have to be difficult. It can be fun. It can be easy. It can be understandable, and that's the whole point of the book. And I would just and when you get it, and you've got a tax advisor that you like, just share it with your tax advisor. This is not private. You don't have to come to us. We're happy to have you, but you don't have to come to us. Go. If you have a good tax advisor you really like, share the book with them. I've never had a tax advisor say anything, and I've never had a complaint from any tax advisor about that book. Not one. I've never gotten a criticism because everything in it is just right out of the tax law. I mean, it's not like, in my mind, it's not rocket science, So it's something that is simple, it's fun, it takes effort, just like real estate takes effort, but the rewards are extraordinary. When you think that the average person is paying 30 to 40% of their income in taxes. I mean, I had somebody describe tax. When you think of the word tax, it's something that's a drag on you, right? It's taxing, right? This is taxing. It drags you down. You cannot get to where you want to go and pay high taxes. It is mathematically impossible to become rich while you're paying high taxes. It is mathematically impossible, unless you're a superstar, right? It's mathematically impossible. For the average person, it absolutely cannot happen. So you have to be reducing it. This is something you have to be reducing your taxes, and it's something you can do every single day, and it's really, really simple.
I think the NFL needs you. They need you to start speaking to the players.
You know what? I'll tell you what. I'll tell you a funny thing. So I actually have clients. I have a good friend of mine, Danny Shays. Was played in the NBA for 18 years. Dad, Dolph Shays, is a Hall of Famer, and he and I have actually we've pushed that, and he's of course got really good contacts in there. The interesting thing is, man, those guys, they listen to their agents and they don't listen to anybody else. I mean, they are like. It's really interesting. They're constantly talking about how they're losing money and getting ripped off and everything. I'm going, well, then get some better advice, would you? I mean, just get some education. And some of them do, and they're good guys. I mean, this is the thing. These are really good guys. A lot of them came out of the ghetto. They've got really good opportunities, but so many of them, like you say, they end up flat broke at the end of in NFL, it's a 3 or 4 year career.
Not for long.
And they make millions of dollars for 3 or 4 years, and then they're done. And what do they have? And for most of them, within a couple of years after that, they're broke. So you're right. I mean, they need you guys. They need education is what they need.
Well, Jake, the mark of a great educator is Tom, because he makes it simple. He makes it easy. I've written a book review. Go on jakeandgino.com. I reviewed his book. I made it nice and easy. I've given you some bullet points. It's an easy book to buy. Go to Amazon. It's $14. It's the best $14 you'll spend throughout this Christmas season. I guarantee it. So
that's right. Start giving some education for the holidays, right, Gino?
Yeah.
There you go. And if they want to listen to it, the only downside, if you want the audiobook, because it is an audio, is that you actually have to listen to my voice for 15 hours.
No, that's BS, because you got energy. That's why. Listen, I have the most fun on the podcast when people have energy. You bring energy to the table. That's what I'm talking about.
Right.
So I don't believe that.
Uh-huh.
I did, guys, before we sign off, because we're running a little long, I did take some notes, and I'll put these in the show notes, but I loved when you're talking about the benefits of real estate and the leverage and the ability to finance big properties with little down. I think that's fantastic. When you're talking about focus on cash flow, don't be thin on your cash flow. That's what we're all about. We buy for cash flow. If we get our cash flow right, the rest of it works out, and that's been our experience. So that was awesome. And the way you explain cost segregation, I got to put you in contact with our cost seg engineer, because that was fantastic about how it was required by law, less of an audit risk, and you can do it at any time. I think those things, guys, for the listeners out there, very, very high level stuff here, and the Untethered Soul will check that out. So, Tom, you are the man. I had such a fantastic time. Thank you so much.
I did too. Thanks, Tom.
It was my pleasure. Absolutely. Thank you, guys.
Okay. We'll talk to you soon. Take care.
Bye, guys.
We trust that you enjoyed the Wheelbarrow Profits podcast. Visit jakeandgino.com, your one-stop shop for everything multifamily. See you next time when Jake and Gino share more of their investing secrets with you.